Welcome back to FT Markets. The eurozone crisis erupted when markets took fright at the level of indebtedness of governments and the private sector across the region. Since then, things have calmed down a lot. Politicians have seen growth resuming and attention's turned to the World Cup football. But the problems of indebtedness in countries such as Spain, Italy and Greece have not gone away. To discuss how serious these problems remain is Moritz Kraemer, who's the Chief Sovereigns Ratings Officer at Standard & Poor's. Moritz, thank you for joining us. I know you've been looking at levels of indebtedness in eurozone countries, and if we look at our first chart, these are your figures showing what's been happening over the last few years. Tell us, where are we in the deleveraging story after all the fiscal austerity and reforms we've had?
Well, the picture speaks for itself. This is sort of the debt added up as a share of GDP from the public sector and the private sector, dating back to the beginning of the eurozone in 1999.
You can see the big explosion.
Big expansion
before the crisis.
of debt. So you can see that even after the crisis really started, that leverage continued to go up as a share of GDP, partly because GDP's plummeted in some of those countries, but partly because of the continuous indebtedness of governments.
And what's significant, of course, is what's been happening most recently and what we see.
Well, what we see is that, there's been some incipient sort of stabilization, but it's certainly far from sort of a solid reversal of the debt ratios.
And how would these sort of levels compare with, say, the rest of the world? I mean, these exceptionally high levels for
these are fairly high levels, and especially if we look at sort of external debt, which is not shown here, you would see that if you look at among all the sovereigns that we rate, on the top 20 net external debt ratios, half of them are actually in the eurozone. So there's a lot of debt in there, in those economies. And, the reversal hasn't really started in earnest yet.
Yeah, okay. Now, what you've done is some work projecting what's going to happen to private sector debt. I think if we can look at our second chart, we can see these are, explain what you've done here. These are your projections for?
Well, these are simulations rather than projections. So what we're doing is we say, well, what would happen if the debt of the private sector, corporates and households, were to decline at the rhythm that they have been declining since their peak with about a year ago. And then we just extrapolate it to 2020. And you would see that for a country like Portugal, which is the second line from the top, that we would go back broadly to levels in 2005.
So it's not a dramatic improvement. We're a bit of a change in the top line, Ireland, but...
Yes, in Ireland, also Spain has been sort of deleveraging more quickly in the private sector. And it's no coincidence that it's those two sovereigns that we recently actually upgraded.
Okay, now the big question, what does this mean for the economic outlook for these countries? If they've still got very high debt levels, can they grow?
Well, very, very good question, very important question as well. And our view is that when you have governments and private sectors who are trying to reduce their debt load at the same time, that means they're increasing their savings rate, but it also means that consumption and investment will be subdued for some time to come. So that means that all the sources of domestic growth are basically pretty much sort of on hold while this deleveraging is going on.
And of course, another important question is the European Central Bank's aggressively trying to stimulate the economy, extra liquidity in the system, trying to boost inflation to head of deflation. If private sector and governments are already heavily leveraged, will that action be effective?
Well, time will tell. We think it's what the ECB can do. The ECB can try to create the circumstances where it's easier for banks to lend, so they can unclog the supply side of credit. But what about the demand side? If these numbers are relevant in terms of how highly leveraged a society is, chances are some of the subdued credit growth that we've seen, and actually shrinkage in many countries, is due also to lack of demand for credit. And the ECB cannot push that string. So it will only be successful in as far as the credit contraction that we've seen on the periphery is really a supply issue.
Thank you very much, Moritz. So a warning there from Standard & Poor's, very high levels of private sector debt, particularly in the eurozone, likely to remain, act as a constraint on growth.